Now I'd like to introduce our panelists for today's webinar. First, we are joined today by Greg Bryant, Managing Partner of Build Group, a boutique law firm focused on international tax and law. Greg, a lawyer and CPA, has over 30 years of experience in international business, law, and tax. Greg was with PwC for 12 years in various roles in their national tax group, including their value chain transformation practice. Greg also was Vice President of Taxes and Shared Services for Alliance One International for 12 years. Before founding Build Group, Greg was Chair of International Tax with Williams Mullen. We're also joined today by Stuart Bugles, VP of Consulting Services for Radius. Previously, Stuart held the positions of Client Services Director and Director of Human Capital Consulting at Nair & Co., and has a well-deserved reputation for his strong customer service ethic and technical abilities that span multiple jurisdictions and disciplines. Qualified as a lawyer, Stuart started his career as a fast-track graduate trainee with Lloyd's TSB Bank, undertaking assignments in legal, marketing, and finance. Later, he went on to specialize in employment law in HR at Lloyd's TSB, attaining his CIPD qualification and operating in a number of leadership roles prior to Radius. Over to you, Greg.
Well, thank you very much, Ed. I appreciate that introduction. Today we're going to cover various aspects of mergers and acquisitions. We're going to start with valuation methods, and then we're going to walk through some of the differences between a tax-deferred, or what's called a tax-free merger, and a taxable, and some of the things we need to consider when we think about income taxes. And then since it's a contemporary topic, we're going to cover briefly acquisitive inversions. And then the HR elements to it, Stuart will walk us through payroll, employee relations, and things that are important to integrating the target with the acquirer. And then we're going to have a broader discussion around ways of structuring your business for global growth, focusing primarily on a case study, and it's one that's in the public domain, as to how Google has structured their international business, and we'll use that to illustrate some of the principles that drive a low tax rate for a global business. So with that, next slide, please. There are various valuation methods that companies use, and I've listed here 4. And these are the 4 that we primarily see when we look at acquisitions. I can tell you that in general, if you hire a company to do a valuation for you, it's very likely you will see all 4 of these in their report. And that allows them to basically pressure test the outcome of each one against a different method. But the ones that tend to be the most useful when we talk about an acquisition and valuing it are the first 2, the earnings cap. But we have earnings cap, we have net present value of cash flow, and then there's liquidation value and comparable business method. The first 2, however, really look at forward forecasts of either earnings or cash flow, and can be very useful in determining what the right price point should be in an acquisition. The last, the liquidation value is probably one of the more unreliable ones in there, and the comparable business method approach is really not one that we would normally use for purposes of an acquisition, because a lot of times it's very hard to find a comparable. Next. Let's talk about the earnings cap method. And that is a very rough cut way of valuing a company. Typically, it'll start with what's called EBITDA, and it'll multiply it times a different factor or a multiplier. EBITDA is an acronym which stands for earnings before interest, taxes, depreciation, and amortization. And in a lot of ways, it is a rough number that is associated with cash flow from operations before you factor in the way that the balance sheet is configured and capital is put into the company, because it ignores really things around interest expense related to debt and the way that the balance sheet is constructed. It is not a cash flow model. Normally the multiplier, as I've seen it, is tied to the growth rate of the company. So the higher the growth rate, the higher the multiplier. And in rough terms, that can mean, for example, if your growth rate is 20%, the multiplier would be the inverse, or 1 over 0.2, which means 5. And so I can tell you from experience with negotiating acquisitions, that multiplier is a point of negotiation. And in a very hot market, in a seller's market, you will see a higher multiplier than you will in a down market or a buyer's market. And 5, I think, is somewhere in the middle of the range that I normally see. For very high growth companies with great revenue growth potential, it can be as high as 10. So let's use a simple example here. If we have net income of 10, taxes of 20, interest of 20, and depreciation and amortization of 10, our EBITDA would be 150. And if we used a multiplier of 5, we would arrive at a value of 750.